Good afternoon, everyone, and welcome to today's program, How to Maximize and Capture Value Within Your Business, a Merger and Acquisition Perspective. This event is brought to you by Pacific Northwest Defense Coalition and Merritt Harbor Capital. First, we want to confirm that those on the line can hear us okay and see the screen. If you could type yes in the question field and just let us know you're all set. Great, thank you. Please feel free to use this same question field to ask any questions at any time during the program. Just type your question in the webinar dashboard and we will share that with our speaker today. On the handout tab, you'll also see a copy of today's presentation and a list of PNDC's upcoming events. Please feel free to download those. We are delighted to have Craig Dickens, CEO of Merritt Harbor Capital, joining us here today. We appreciate Merritt Harbor hosting this program today in response to the many questions we received at our last PNDC member CEO dinner. Craig Dickens is the CEO of Merritt Harbor Capital. He is a serial entrepreneur and investment banker. Craig has personally started or acquired 15 businesses across diverse sectors, as well as executed 19 add-on acquisitions within those companies. Craig graduated from University of New Hampshire and attended Babson College's top-ranked entrepreneurial MBA program. Craig holds Series 24, 82, and 63 licenses and specializes in sell-side, M&A, buy-side advisory, and capital placements. Today's presentation will focus on key value drivers for privately held companies to help owners, stakeholders understand what their company is truly worth, expand on how to work on your business as opposed to in it, and lastly, he will cover the capital marketplace and options for owners to exit, grow more quickly, and ultimately plan for the future in a way that captures the company's maximum value. Thank you for joining us here today. Craig, you may begin the presentation.
Thank you, Kate. Appreciate it. It's our pleasure to be participating with PNDC, and on behalf of our team members at Merritt Harbor Capital, thank you for the opportunity to speak to you today about an important topic that a lot of folks will be facing, especially the baby boomer generation, the most entrepreneurial generation thus far in the United States history. We have a lot of folks that are, coming up upon a transition in their company, and we really want to be a part of that dialogue to help those companies understand what's at stake, and then and really truly prepare to have a great exit or transition from their business. I'm joined today by one of our managing directors and investment bankers, Jake Matei, who's here with me. I'll kind of go through the deck, and then I think he'll answer some of the Q&A questions as well. Also on our defense and aerospace team is Nick Devaney. He's part of the Merritt Harbor team based out of Tacoma. And again, thanks for the opportunity. So kind of our topic, as Kate mentioned, is dealing with an issue that is important to not only our local economy, but certainly the individuals and the business people that are driving our local economy, which are those businesses, what we call in the lower middle market or middle market. Folks that run, multi-million-dollar companies up to, hundreds of millions of dollars of companies. They're the economic driver for this region and for the United States in general. So what we'd like to do is, share a little bit. See if we can advance that here, about the overall market. In the Pacific Northwest, we have approximately 200,000 businesses that fit that description, and over 45,000 in the middle market, which is 20 million and up. And again, baby boomers hold most of those businesses, and they will be transitioning over the next 10 years or so. A lot of economic wealth transferring, a lot of jobs attached to those companies and businesses. So, we all have a vested interest in seeing, small business be healthy in the region and transfer well. And I guess our first message there is preparation. Richard Branson's quote on the right, applies to all of us in terms of our preparation for a transfer of our business, and indeed, going to the next level with our estate and retirement planning. It's all about the planning and preparation stage. A couple of more statistics, in case and in general we see this in this region and across the country. Most business owners have a great deal of their net worth tied up in their relatively illiquid companies. It's not like we have a stock market for smaller companies where I can place a trade and move all of my shares. It's a little bit more of a process than that. And boomerpreneurs who have built their companies, focused on their customers, have grown the business, sometimes don't do as good a job as they would like in terms of focusing inward in terms of their transition and exit plan. And there's been several studies of this in the marketplace, and certainly preparation is probably needed, and having those professional and trusted advisors like your estate attorney and your CPA and your investment banker kind of helping you through that and planning for that is really the answer. When it comes to valuations, and as you sit today in your company, if you are one of the many folks that values your business based on kind of anecdotal evidence, well, my buddy who had a similar business sold for $20 million, that is a little bit fraught with error. And again, MassMutual did a study that shared the conclusions were that business owners value their company by approximately 59% greater value than its actual value when it was sold. So if you're planning for retirement, thinking about what the next steps are or what your business might be worth, and you're working with your wealth manager or your stockbroker, chances are the value that you put down on the piece of paper for your business may not be representative of what the market will pay for it in a transaction. And dovetailing from that, some folks have been left at the altar because they weren't prepared or they had unrealistic value expectations. Part of our job in this marketplace and to come alongside business owners is to give them the empirical information about valuation, as well as how the marketplace is valuing a given company. If you're a machining company, primarily in the aerospace market, those companies tend to trade within a certain range, based on the performance of the company. So we obviously want to help owners do that. One of the things that we like to categorize and get people thinking about and making that mental transition from working in your business to working on your business is to really just kind of do a gut check of where you are. Some folks find themselves kind of working for their company. They may be the last ones to get paid, or they may be in a turnaround situation where it's really hard work and you're working for the company. A majority of us are working in our businesses. We are CEO, president, owner, wear lots of different hats, or even in larger organizations, we're still in the day-to-day of the business, and maybe even taking a functional role. As a CEO, sometimes you operate as the VP of sales, sometimes you operate as head of purchasing, and the list goes on. So certainly, one of the things in terms of really changing your focus and setting your mind right around what the future might hold for a transition is to begin to think like an investor, or someone that owns the company but is capable of working on the business, or dedicating some time to not just working in the business but also work on the business. That is perhaps one of the greatest gifts you can give yourself and your family when thinking about a transition, is to spend that useful time away from the office, off-site, meeting with other business leaders, talking to your key advisors. Many folks kind of dismiss conversations of, well, I'm going to sell when my biggest competitor buys me out. Well, that's not necessarily a plan, that's hope. And again, we like to help owners kind of carve out the time, create the time and the discipline and the tools to work on the business. I've got another investment banker friend who wrote a book called Time Really Is Money. And, his whole thesis is, as the owner of the business, in order to truly create value, you have to be working on $1,000 an hour type work, not $20 an hour type work. And we all get caught into the up with the urgent versus the important. And again, working on the business can really pay dividends, especially when you are contemplating either a partial sale, full sale, or a transition in the business. Sadly and unfortunately, most business owners, don't do this, and as a collective, they leave, trillions of unrealized value. They typically have lifestyle businesses that have really done well, and they may have created a good deal of personal wealth and put their kids through school, but really that investment grade business requires that we kind of make that mental shift to working on the business. So one of the things that we ask, and again, we don't want to sit here and just offer advice. We also want to start to make that tangible in terms of what you can do to create some value. And again, the first and foremost is understanding what makes your business tick through the eyes of an investor or an acquirer really starts to have us focus on valuation and value drivers of the business. So what is a value driver? Obviously, things that increase value of the business as viewed by investors. And a buyer for your business, if we try and break it down very fundamentally, what do they care about? They care about your stream of cash flows. Are they reliable and recurring? In other words, how long have you had your current customers? How much do they buy? Are they growing, or are they going in the opposite direction? Is it contractual revenue? These are all kind of building blocks of value. And then certainly on a go-forward standpoint, once you leave and ride off into the sunset, will those streams of revenue and or cash flows continue? And how much can we de-risk the future? That's part of the value conversation while you're working on the business. So if you have a 5-year contract, going forward, you've obviously de-risked those future revenue streams. And again, that adds to your value as a company. So when it comes to value drivers and things that you can do tangibly, we generally break those down into 18 segments. These are the things that make most businesses work and make them valuable. Do you have recurring revenue? Do you have a significant share in your market? Do you have customer diversification? I know that's kind of a funny topic when we're dealing with aerospace and defense. Because you may only have a handful of potential customers, and again, the market is aware of that. Do you have any IP or barriers to entry? Is your leadership team, strong in terms of taking your business to the next level? So this look at the business, what we do is, from a recommendation standpoint, is we encourage companies to establish a baseline, to get a valuation to say we know where we are, and then undertake what we call a core value assessment, which after this webinar we will circulate a link. It can be found on the bottom of our website, but we'll circulate that link as well. And that core value assessment goes through those 18 value drivers, and it kind of gives you an idea of what areas of your business are strong, what areas there are gaps in, and how you can close those gaps based on other companies in your market that have sold. And that on our website, we've got, you start very quickly, you answer about 15 questions. It'll take you about 10 or 15 minutes, and that'll give you a report out on your business. And certainly that's kind of a high-level look. And we'd love to work with you to kind of deep dive and maybe spend a half-day session so that you can better understand and refine the value drivers of your business. So if we make that a little bit more tangible as well, again, we talked a little bit about customer concentration. if 70% of my business is tied up with 3 customers, or we do, one particular thing, the strategy in building value over the next 2 to 3 years, if you're contemplating a sale, is to pursue, some segment or product diversification strategies, or the inverse. If you're the best in the world at manufacturing a certain widget, let's keep leaning into that and dominate a niche. That's another aspect of our potential way of creating value. So I hope that's kind of actionable, and again, we will send out that link so that you have something to start setting a benchmark for your company, as well as maybe some tangible things you can do to increase value. If I leave you with 3 things as far as starting to look at the market and how companies or acquirers will look at you, they will pretty much look through these lenses on a first brush. Is your company growing, and at what rate? Because growing companies are inherently more valuable than companies that are declining or shrinking or have reached the apex of their life cycle of their products or their relationships. Your EBITDA or your earnings, are they consistent? Are they growing? And certainly the higher the number, you will attract more buyers, and you will attract higher values for the company overall. And then lastly, some of the strategies that many of our clients are deploying are, if we're a smaller company, the bigger companies tend to trade at higher values, just because if they lose 10% of their revenue and they're a $100 million company, it's not as catastrophic as if you're a $10 million company and lose $10 million in revenue. So there is a size premium, and one strategy that folks are deploying is, if we're a $5 million company and we know a competitor who's a $5 million company, maybe joining forces with that company to increase our size and therefore get a higher multiple when we go to sell. So these 3 things on a macro sense, if you remember anything from this presentation, is waking up every day thinking about how I can increase growth rate, how we can increase earnings and sustainable earnings. And as we move up in the size of our business, we will inherently become more valuable. I'd love you to kind of remember those as we go forward. Again, wanting to make this tangible in terms of working on your business, one of the things that leaders and as entrepreneurs, we often have strong personalities. We're the visionary for our company, or we are the top tradesman, if you will. We invented that which we're selling now. But really, part of our obligation in making our company transferable is that we build up the second layer of management or the third layer of management, so that we make ourselves replaceable, and that vision and that roadmap for where your business is going has intention. So a lot of times we'll recommend a tool, and there are several out there, but I really think if you haven't seen this one, it's a great, you can start it tomorrow. It's a great roadmap to give your business traction and to get your entire team, pulling on the same rope together. It's an entrepreneur operating system by Gino Wickman. The book is Traction. You'll see other books out by these folks, and there's really, you just have to buy the book, and then all the rest of the tools come with it, including some software that doesn't come with it, but companies have really jumped on making the book and the printed materials very actionable for management teams to guide their business to the next level. Same thing with core value. The software provides a dashboard, if you will, so that as you improve value, it shows you the incremental improvement. You can assign tasks to your team. Those 2 tools put together are really powerful for companies wanting to increase their value. Have we done anything dramatic? Have we spent money on R&D? Have we done some other things that are important in the value driving system? Not necessarily, but just by implementing these 2 things, we think it'll set your framework and your company on a good path towards value enhancement and value improvement if you're contemplating sale. Now we get into kind of the fun stuff, and forgive the slide here. It's the oldest joke in mergers and acquisitions and investment banking. Everyone's going to leave their company. It's up to you to decide how you want to leave, horizontally or vertically. And the guy on the right obviously just cashed a very large check for his company, so he's pretty happy. The other guy didn't quite make it out of the office, and his wife is very upset with him. He's just kind of given up. So one of the things we encourage entrepreneurs that are approaching either retirement age or a transition or wanting to pursue something different in their life, you really have to ask yourself and answer the question, what do you want? And again, here's where your advisors, your core team of advisors comes in to help you craft that, to give you some market knowledge, to begin to look at your tax ramification and estate planning. But really, what do you want from your company and from the next stage of your life? Your options to then pursue are to do nothing, and statistically, about 30% of lower middle market companies, especially smaller companies in the sample, will liquidate and sell off their equipment, or sell off their equipment to 2 or 3 different players. Others will transfer the company to employees through an ESOP. Others will have a family succession. But the point we're trying to make here is get with your advisors, get with your family, and kind of get real about a plan, because doing nothing is not a great alternative. So this particular slide is a little bit of an eye chart here, but I can simplify it a little bit for you. Again, most entrepreneurs think, well, I know the competitor that's going to buy me, or my son-in-law is expressing aspirations to buy me. There's a lot of different ways that you can exit your company, pardon me. I just kind of wanted to give you a couple. So if you've got all the money in the world and you want to leave it to charity, that is definitely an option that more and more entrepreneurs are taking. If you have a business that has a management team, you can leave it to your family. They don't necessarily need to run it. You can have professional management. Your co-owners or partners, a lot of different ways to facilitate that sale, kind of an internal sale. Most folks in today's market, where private equity and others are chasing good companies like yours, will look to sell to an outside investor through several different means. And then, there's a lot of different options there. Again, it's not just kind of a cookie-cutter strategy. We work with companies that have, deployed just about every method of selling their company possible. A handful of companies, probably the larger companies, will be suited to go IPO or public. And then again, there is a growing, ESOP, especially as there's, great companies out there and great leadership teams, ESOPs, management buyouts, and other ways to facilitate exit. So I guess the bottom line for your investment banker in the mix is to share, educate, and look at all the various options, so that with those options you can be in charge of not only your timing, but how you'd like to exit the company as well. I think looking inward a little bit, and this might be a little touchy-feely for some, but there are kind of 2 things when we work with folks, and this is a good conversation for you and your family, or your wife or husband. What is our financial readiness to contemplate this transaction, and what is our mental readiness? We ask folks where they kind of fit on this quadrant. Again, if you're mentally ready, some folks are like, get me out of here, I'm done. Other folks are, yeah, if someone made me a great offer, I'd be okay, because I've got hobbies and kids and grandkids and other things I'd like to do other than go to work. And then again, on the financial side, some folks are well off but choose to work, and others, need to stay and grow to complement, augment, or supplement their retirement picture. Which door do you take? Similar to the kind of 30 ways to exit your company, these are some of the options that are available to you depending upon where you fit and what you'd like to pursue. And to make that even more meaningful, so you can kind of bucket yourself here, if you are, depending upon your revenue and your earnings, these are typically the most likely acquirers for your business. You know, if you're a $2 million business, will you go IPO? Probably not. It's probably a competitor or employee-led or someone in the family. If you're a $20 million business with, you know, 4 or 5 million in EBITDA, you know, you've got some large institutional buyers and strategic folks that would very much be interested in your business, you know, going forward. So I hope that's helpful as you start to kind of get your hands around, you know, who that might be and what that might look like. So, you know, what buyers look for, and again, these are six of probably 20 key elements, but these are probably the most noteworthy. And for some of you, you already know this, but I want to make sure that we're touching a broad audience here. You're second in command. If you leave, the old hit by the bus test, you know, your leadership team. If you've developed a good team, in our business, they say, what's a valuable company? It's the company that doesn't depend on its owner. That makes you pretty valuable in terms of working on your business and developing that team. I can't tell you how many deals we get into where even $100 million companies don't have financials that pass the scrutiny of buyers and third-party lenders. So I can't stress the fact that having professional financials, audited financials in particular, will help you, you know, consummate a transaction. And then, you know, to the point earlier where we had they're buying your past streams of cash flows, but they're also are going to buy your future streams of cash flows. The degree to which you can help a new owner who may or may not know your secret sauce or your market, you know, handing them a growth plan and something that you've, you know, put some deep thought into as to how the business is going to go on after you leave, that's going to be important to that mix as well. Again, any time we can solidify revenue, de-risk the acquisition, have contracts in place, agreements in place, you know, that only helps us become more sellable. And then, you know, if we've got a great revenue plan, but, you know, we're losing money out the back door of the plant because of operational inefficiencies, it has to be a balance, right? We have to be operationally ready because, again, if someone's going to pay you top dollar, the way they get their investment return is by growing the business and growing it profitably. Otherwise, they're not going to meet their expectations, and they'll probably reflect that in the price that they offer you. So a good sales and marketing plan, growth opportunities, along with, you know, operational efficiency and execution capability, that's a bit of a dual threat. And then, you know, many businesses, obviously, you know, while they're growing, some of those customers may be new, and new business is incredibly important. But equally important is a loyal customer base that has been with us, that understands the value that we bring to them, again, so that we can de-risk the future. Those 6 things in general are the main buckets of what buyers look for. You know, important next steps, like we talked about with traction and with core value, understanding your value. Also, perhaps if you're going to hand the keys to a management team, or if a new buyer is going to rely on the management team, you know, one of the things that we do with folks is put together assessments and rankings of the management team, maybe some coaching if necessary. And again, looking at things like your customer concentration, or what can we do to kind of diversify that risk. Those are really important for next steps. And, you know, again, getting those financials in tip-top shape and working with the other folks that are your trusted advisors in the business. So I hope that that kind of gives you a primer of kind of working on your business and working on value enhancement and what that might look like through a buyer lens. And then this is perhaps a bit of a teaser for the next webinar. Those of you that are interested in the process and what we do and how that happens and how we work with you to button all these things up and then take you to market. It's generally a 6-step process where we work together to put selling materials and financial materials together. We go out and we study the market. Obviously, we're in the marketplace. We know who a lot of the buyers are, but we believe in a broad outreach to get as many folks in a process as possible if that suits your business. We market the deal, and we can do that, again, in a broad way or in a very quiet and strategic way. We get inbound or negotiate with those acquirers to get you the best deal, and that will manifest itself in a letter of intent, LOI, at which time the buyer will want some exclusivity while they conduct due diligence. Then they get in and do some due diligence and make sure all the things that we've told them are true. Look at your financials, look at your sales and marketing, look at your product, look at your history. And then hopefully if we do all of those things well, we get to final negotiation and closing the deal. So again, that's a bit of a primer for perhaps our next webinar. But at this point, we wanted to open up the floor for any questions. And if folks have specific questions or related to their business, we'd love to talk about those.
Great, thank you. And as a reminder, anybody on the line is welcome to type in their question, and we can definitely have Craig and Jake address those. It looks like, and if everybody wants to put it on your the calendar, the next webinar will be June 13th. We'll talk a little bit more about the M&A process. Thank you so much. Looks like we do have a few audience questions here. First of all, I'm not ready to sell. How does a buy-side process differentiate from a sell side?
Yeah, so typically when we run a sell-side process, our job is to create that competitive environment to really drive value. When we run a buy-side process, we try to do the opposite. We try to avoid that. We try to go turn over some stones that find the companies that aren't necessarily on the market, start some conversations that strategically make sense for the buyer. We have some proprietary databases that we use to pull up names, and we do a lot of cold calling, and it does become a numbers game. But what that yields is typically opportunities that are what we would describe as pocket deals, as opposed to having to go compete and bid against other buyers. So that's the primary difference from our perspective in how we run those two processes.
Great, thank you. Another audience question, when is the best time to sell?
So while it may not be counterintuitive, it can often be counter-emotional. Typically the best time to sell is when the company is healthy, it's doing well, after a owner has addressed all those value drivers, and there's very clear visibility of continued upside. That's where you're going to generate absolutely the most interest. If it's sad but all too common that a business will start to struggle and owner will get burned out, and that's what precipitates the decision to sell. And that's really a bad time to sell, because you're obviously going to be discounted. The value is going to go down because of the performance of the company. So typically when the owner's making a lot of money, having a lot of fun, and everything's going great, that's when the business is the most valuable, and the ideal time for the business to sell. Obviously that has to align with the owner's goals in terms of retirement and financial planning and that sort of thing.
Great. Another audience question. I get phone calls every week with someone interested in buying my business. Are these legitimate, real?
Yeah, Jake, thanks for answering those last two questions. I'm going to jump in on this one. Typically they're real, and what they're trying to do is exactly what we would do on the buy side. They're trying to buy you before you get educated, before you get prepared, and before you have a competitive process, because they want to buy low and sell high. So, one of the things we do, is to help folks, prepare, get ready, and orchestrate, an auction process where we get 10 buyers to bid for your business, if you will, so that we can drive that price up and you can maximize your sale. So they're doing their job by calling you and bugging you because they want to buy companies, and certainly, we're your advocate as a licensed investment banker. To keep those folks in line and make sure that you get the best deal that you can.
Great, thank you. Here's a question. How do I avoid people finding out when I go to sell, possibly employees or people that they don't want to have know about the process, at least initially?
Yes, that's an extremely common fear. As business owners, we're very sensitive to our private information. We don't want our competitor to find out and start calling all of our employees, and there's always a concern that it sends the wrong message to the market. And while it's probably impossible to completely eliminate that, running a professional process is the best way to go about it. We work with people that buy companies every day. Even the strategic buyers are a more sophisticated class. We cover everything through non-disclosure agreements, so we paper everything legally. But really working with a more professional buyer base is the best way to protect against that. And I think cumulatively our experience has been very positive in terms of keeping things confidential where they need to be confidential, yet still being able to go out and reach the market that needs to know that we should be having those conversations. So it's a very legitimate fear, but running a professional process can typically mitigate the majority of it.
Great. This is a two-part question. What should somebody do to prepare for an initial meeting to discuss a possible sale, and how long does the process usually take?
Yeah, so the preparation side of that, we're gonna ask for similar information to that which a bank asks you in terms of your financial statements and general descriptions of the business. But really doing a self-assessment based on the value drivers, and Craig spoke to the core value tool earlier. If you can be very honest with yourself, looking inward and trying to identify risk areas of the company, that helps us understand where we need to either fix things or certainly highlight them. And so from a preparations perspective, identifying your own value drivers, your own weaknesses, and being honest about it, and then just come prepared with all the financial information and typical details and documents that a bank would ask for. Now, I think the second part of the question was, how long does a process take? I think it was the last slide before this, and we'll probably go into it in more detail on the next webinar. The process itself, from the day we sign an investment banking agreement to the day we're saying cheers and celebrating a closing, is very commonly 6 to 9 months. I will say that from our perspective, we like to be talking with people ahead of time, years and years ahead of time, so that they can work on some of those value drivers, so that when they are ready to go to market, we're able to achieve the optimal result. So the process itself, once it really starts, is that 6 to 9 month period, but really preparing to get to market can take up to years in advance.
Great. If somebody has a horizon of 5 or 10 years where they're looking at exiting their business, when should they call you, and how would that process work that far out?
They should call us today. Conversations are free, and we like to develop a relationship so that we can really understand the objectives of the owner, understand what those goals are. There's a lot more than just the dollar figure at the end. Typically, a business owner wants to make sure that he's taking care of his employees or her employees. They want to have all their personal financial planning in place. So there's a lot to do ahead of time. So even if there's no immediate exit in your future, it's still a really healthy conversation. We enjoy having that conversation and are happy to do so.
I would add to that there's important considerations in tax planning. Sometimes, the marketplace dictates what your company is worth ultimately, but you do have a say-so in your tax planning, tax structure. Even without value enhancement work, there are some things that you can do early by engaging your CPA and your investment banker and putting together an overall strategy, that hopefully dovetails with a wealth creation strategy, that you've worked with your broker on or your wealth manager. So, again, another axiom in our business is, every business should be run as if it can be for sale. And really doing that prep work, we find that people, whether they sell or not, some of the things that you can do to increase profitability by planning and working on the business, there's real return on investment there, whether you choose to sell or not.
Great. Thank you so much. We really appreciate you both joining us here today and look forward to the webinar coming up in the future. We have recorded today's presentation, and I'll make sure that is sent to everybody on the line here today, as well as those that were not able to join us live. And this will also be a resource available in the PNDC member resource library. Thank you again, Craig, Jake. We appreciate lending your considerable expertise to PNDC. We know this will be valuable to all our members.
Thank you, Kate. Have a great day.
Thank you.